Yes, now we'll discuss audit of different items of financial statements, which most of the CA intermediate students they will take this chapter as choice, right? See, you should not take this particular chapter as choice because you will be getting at least 10 to 15 marks, minimum 8 to 10 marks you will get, max 15 marks you will get from this chapter. Yes, the content of the chapter is very huge and it is very difficult to remember this chapter. So what I have done is, for all the chapters that we have discussed, we are having a chart book, right? Now this chart book, it will be even very much useful for this chapter, audit of different items of financial statements, because the complete content you will be able to read and revise within lesser time and also within less pages. So now you no longer feel this chapter as huge chapter. So from now you need not take this particular chapter as the choice. Clear? So we will revise this chapter. First of all, before revising this chapter, you should be very clear with the term assertion. First of all, we will discuss what is meant by assertion. Then we will start revision of the chapter. Basically, assertions are representations made by whom? Management. To whom? To auditor. Where these representations will be present? In the financial statements. Let me tell you. So management, it will prepare financial statements. In the financial statements, in balance sheet, they will mention assets, fixed assets, current assets, all that they will mention, assets, amount they will mention. So here, by mentioning assets in the balance sheet, management is making a assertion to the auditor that auditor, we are having assets worth 2 crore rupees. So whatever the valuation of 2 crore rupees that has been shown in the balance sheet, that is correct only. Like this, management is making a assertion. Similarly, if it is showing assets in its books of accounts, it is also making an assertion that those assets belong to the entity. Entity is having right over those assets. Next, if it is showing assets in the books of accounts or in the balance sheet, it means that entity is making a assertion to the auditor that these assets are really in existence, nothing but existence assertion. Getting it? So by including certain items in the financial statements, management is indirectly making a assertion to the auditor. So with respect to balance sheet items, you will have assertions like valuation, completeness, existence, rights and obligation, right? Similarly, with respect to P&L also, management is making certain assertion. Example, it is showing sales 10 crore rupees. That means it is making an assertion that during the year 10 crore rupee worth sale has occurred, nothing but occurrence assertion. Next, whatever 10 crore that we are showing, that is valued properly only, nothing but accuracy. And we haven't missed any sales from disclosing in the P&L, nothing but completeness assertion. Getting it? So, like this, management will make various assertions to the auditor through financial statements. Now, okay, management is saying various things. See, assertion means what? Saying that something is true. Now, if just management says that this is true, that need not be true. Here, the auditor's duty comes. Auditor has to verify whatever the assertions that the management has made. So that's what you will do in case of audit, right? You will verify various assertions that the management has made in the financial statements. Now this chapter is nothing but how to verify those assertions. See, financial statements, if you see, financial statements, if you see, in the balance sheet, you will have share capital, reserves and surplus, borrowings, trade receivables, cash and cash equivalents, inventory, PPE, intangible asset, right? Trade payable. All these items you will have in the balance sheet. Now, each of this item will have various assertions. The auditor's duty is to verify those assertions. Completeness assertions, existence assertion, rights and obligation assertion, auditor needs to verify it. So this entire chapter contains various points, various procedures that the auditor has to follow for verifying the assertions with respect to these items. Clear? So here the areas covered in this chapter, these are the areas that are covered in this chapter, which are nothing but balance sheet items. So with respect to all these areas, how to do the audit, how to verify the assertions of all these areas, we will be discussing. Similarly, with respect to P&L also, there will be certain items, sales, purchases, employee benefit expenses, depreciation, other expenses, lot of items will be there in P&L also. So with respect to P&L items, what audit procedures auditor has to perform, that also we will be seeing. See, P&L items, sales, other income, purchases, employee benefit expense, depreciation, other expense, rent expense, power and fuel. So with respect to all these P&L items, what procedures auditor has to perform, that's what we will be covering in this particular chapter. So you got a brief idea what will be covered in this particular chapter? Yes. Now, starting with the first item, share capital. So you already know what is meant by a share capital, right? Now, how the auditor will verify this share capital? What are certain general audit procedures that the auditor will perform to verify the share capital? First of all, in the balance sheet, there will be share capital that will be shown. You need to match, tally that share capital that is shown in the balance sheet with the books of accounts. So, tally period end share capital. Now, if there is no change in the share capital, that means whatever the opening balance of share capital is there, same is the closing balance also. That means there is no change in the share capital. In such a situation, you need to obtain written representation from CS, company secretary. Sir, why you need to obtain written representation from the company secretary? Because all the aspects with respect to compliance with the Companies Act will be taken care by company secretary. Now, if at all there is any change in the share capital, company secretary, he would be filing certain forms with MCA. There are certain forms, PAS 3, SH7, these forms needs to be filed. So the company secretary, he will be having knowledge of whether there is any change or no change in the share capital. So if there is no change in the share capital, obtain written representation from the company secretary. If at all there is a change, that means if there is any addition to the share capital, that means new shares issued or buyback from the existing share capital, then you need to check whether it is within the authorized capital. So see, there is this concept of authorized capital and issued capital. You might be already knowing it, right? So issued share capital should always be equal to or less than authorized share capital. Issued share capital should not cross the authorized share capital. So if at all there is any increase in the share capital, auditor needs to ensure that whether that increase is within the authorized share capital or not. And for the purpose of increase of share capital, you will pass board resolutions, shareholder resolutions. So obtain certified copies of those resolutions. And in case any fresh issue of share has been issued, then you need to file certain returns as per Companies Act. What are those returns? These only: SH7, PAS 3. SH7 is notice to register about alteration, PAS 3 is return of allotment. So in case of fresh issue, you need to check whether that return of allotment, PAS 3, has been filed or not. And another important point with respect to share capital is you should not issue share capital at a discount. You can issue shares at a premium, but you should not issue shares at a discount. So auditor needs to see whether any shares have been issued at a discount. If at all any shares are issued at discount, it will be void ab initio. That means it will be void, it will be invalid. And if shares have been issued for consideration other than cash, then auditor needs to see whether the position that is reflected in the financial statements in the books of accounts, whether it is proper or not. Next, if at all you are a listed company, then in case of listed company, apart from the requirements of Companies Act, even the requirements of SEBI LODR regulations will also be applicable, right? So if you are a listed company, you need to see whether compliance with SEBI regulations have been done or not. Next, if you are accepting share capital in foreign currency, that means some foreign investment you are accepting, in such a situation you need to file certain forms with RBI. So auditor needs to check whether such forms, the form name is FCGPR, whether that has been filed in case of foreign direct investment or not. Foreign direct investment means some foreign people, they are investing in the foreign currency in our company, that is a foreign direct investment. And in case there is an increase in share capital, then calculation of required fee and stamp duty, whether it has been done properly or not, because whenever you increase the share capital, you need to pay stamp duty on that increased share capital. That stamp duty, it varies from state to state, because stamp duty is a subject matter of state government, right? Next, issue of shares at premium. Can you issue shares at premium? Of course you can issue. There is a separate section of the Companies Act, section number 52, which deals with shares issued at premium. Next, if you issue any shares at premium, premium means more than face value. If the face value of share is 10 rupees, you are issuing that share as 20 rupees or 15 rupees, then the additional 5 rupees is the premium. Now this premium amount should be credited to a separate account by name securities premium account. So you need to see whether that premium has been credited to securities premium account or not. And this securities premium account, it cannot be used for whatever the purpose you wanted. Securities premium account can be used only for certain restricted purposes. What are those restricted purposes? First of all, issue of bonus shares. So in order to issue bonus shares, you can use this securities premium account. Next, to write off preliminary expenses. Preliminary expenses means certain expenses that you have incurred before the company has been incorporated will be known as a preliminary expenses. Like you might hire a professional for incorporating the company, you might have to pay certain fee to MCA for incorporating company, right? So all these expenditure you might have incurred before incorporating the company, that will be known as preliminary expenditure. So for writing of the preliminary expenditure, you can use this securities premium account. Next, writing of commission paid or a discount allowed on what? On shares. So, not shares, because shares you cannot issue at discount, but there are certain exceptional situations in which you can issue shares at a discount. We will see sweat equity shares can be issued at a discount, and as part of resolution plan, you can issue shares at discount. There are certain 2 to 3 exemptions for issue of shares at a discount that we will see. So, in such a situation where you have issued at a discount, the discount amount has to be borne by whom? Company has to bear the discount. So for writing off that discount amount, company can use securities premium account. That is, share price is face value is 10 rupees, but you have issued a share at 7 rupees only. The balance 3 rupees is there na, that can be written off by using securities premium account. Next, for providing premium payable on redemption of preference shares or debentures. So sometimes what the company will do is, now the company has raised some uh, preference shares. It has issued some preference shares. The value, the face value of each preference share is 100 rupees. So by issuing preference share, it has collected 100 rupees. It told that after 10 years, it will redeem. Redeem means repay that preference shares at 120 rupees. So you are redeeming at premium 20 rupees. Now this 20 rupees has to be borne by the company. Company has to bear this 20 rupees. So for writing of this 20 rupees, you can use securities premium account. Next, buyback for purchase of its own shares. Securities premium account can be used. Got it? Yes. So if you see in this chapter, whatever we are discussing under this share capital, this is very important. I will be telling you which are important concepts. You focus more on those particular concepts. Okay, whatever we are discussing in the share capital, complete share capital is very important. Clear? So, issue of sweat equity shares. Sweat equity shares means sweat, not this sweat. So, the shares that you issue to employees is known as the sweat equity shares. So, employees, they have provided you service. So, for that service, instead of giving salary, you will give sweat equity shares. Generally, these sweat equity shares you will issue at a discount to the employees. Okay, it is permitted to issue sweat equity shares at discount. See, the general rule is shares should not be issued at discount, but sweat equity shares can be issued at a discount. See, issue to employees at discount for consideration other than cash. Now, with respect to these sweat equity shares, what points has to be verified by the auditor? First of all, these sweat equity shares should not be of a new class of shares. The class of shares that has already been issued, such a class of shares only can be given as sweat equity shares. Sir, what is meant by class of shares? See, in the company, there is shares of face value 10 rupees, face value of 100 rupees, and there is also shares whose face value is 10 rupees, but for this share, you will get two voting rights. Now, these are different classes of shares. So, face value 10 rupees, one voting right is one class. Okay, one voting right. One voting right is one class. Face value of 100 rupees is another class. Face value of 10 rupees, two voting rights is another class. Like this, the different classes of shares will be there in the company. Now, the class of shares that you issue as sweat equity shares should not be a new class of share. Okay, such a class of share should have already been issued to the shareholders. Only such kind of old class of shares can be given as sweat equity shares. So that is the first rule that has to be seen by the auditor. Next, whenever you wanted to give sweat equity shares, special resolution by shareholders in the company is required. So, auditor needs to ensure whether issue of sweat equity shares is authorized by special resolution or not. Next, that resolution should specify number of shares, current market price, and consideration that has been charged for issue of sweat equity shares. And of course, if you are a listed company, you need to comply with the requirements of SEBI with respect to these sweat equity shares. Next, so I told you now there are certain exemptions for issue of sweat equity shares. We will see that the basic rule is that if you issue sweat equity shares, it will be void. That is the basic rule. But the exemption is that you may issue sweat equity shares to creditors as part of resolution plan. This is the exemption. So resolution plan means if company has this resolution plan is concept of insolvency bankruptcy code. So if company has filed for insolvency, then straight away government will not close the company. It will ask any people are there who are willing to buy this company which is under insolvency. If at all anyone is willing to buy this company, the government will ask to submit a resolution plan. So resolution plan is how that person who is going to purchase this insolvent company wanted to revive this company. So a plan will be prepared. That plan will be known as a resolution plan. So as part of that resolution plan, shares can be issued at a discount to whom? Creditors only. Understanding? Yes. If you fail to comply with this section, that means if you issue any shares at a discount, apart from this exceptional situation, there is a penalty also. So penalty on the company. What penalty company has to pay? Amount equal to amount raised through discount or 5 lakh rupee, whichever is lower. So how much amount you have raised by issuing shares at discount or 5 lakh rupees, whichever is lower, that amount you have to pay as a penalty who on company. Next, company shall also be liable to refund all the money along with 12% rate of interest. So this is the punishment on the company if it issues any shares at a discount apart in the exceptional situations. Next, going to the concept of reduction of capital. So there will be two situations in this reduction, in which reduction of capital can arise. So what is meant by reduction of capital? Reduction means capital amount is reducing. So why capital amount can reduce? Let's say for example, the company is having assets worth some 100 crores, but the value of these assets has fallen to 50 crores due to some market situations or whatever the reason, value fallen to 50 crores. So value of assets fallen to 50 crores, but still in the books of accounts you are showing it as 100 crores, which is not correct. You need to write off. Now for writing off that 50 crore amount, you need to have some reserves. If you don't have sufficient reserves, then that amount will be written off from the share capital. That is the first reason why reduction of share capital can arise. Assets of reduced or doubtful value, because of which reduction of share capital can occur. Next, if let's say second situation, company is having excess money, okay, idle money is available with the company, so company wanted to buy back its own shares. So what the company will do, company will give amount to the shareholders and it will buy back the shares and it will cancel the shares. So that is the second reason why the reduction occur. Okay, that second reason specifically we will term it as buyback. Got it? Yes. So with respect to this reduction of share capital, what points has to be verified by the auditor? See, this is specifically section 66. Whenever the term reduction is used, you need to consider only the first situation. For the second situation, there is a specific name called as buyback. Buyback is dealt by another section of the Companies Act. Section 66 deals with only with this first situation. So with respect to this reduction of share capital, what points need to be verified by the auditor? First of all, whether the requirement of section 66 has been complied or not. And if company wants to reduce its share capital, permission of shareholders is required through special resolution. So whether special resolution has been passed or not, you need to check. Next, another important thing is articles of association of company should authorize the company for reduction of share capital. And once the share capital has been reduced, company needs to alter its MOA. Why? Because in MOA there will be certain clause, capital clause. So you are reducing the share capital, proportionately you should also alter that capital clause in the MOA, right? So AOA should authorize and verify MOA of company has been suitably altered or not. Next, another important point is whenever you wanted to reduce the share capital, the auditor needs to ensure that there is no default with respect to payment of deposit holders. Sir, why sir? See, deposit is the liability for the company. You have accepted deposit, it is a liability for the company. Share capital is a own fund of the company. Now, instead of giving money to the deposit holders, you are giving money to the shareholders, which is not correct, right? First of all, you have to repay outsider liabilities. So, whenever you want to reduce the share capital or whenever you want to buy back, auditor needs to ensure that there is no default to the deposit holders in repayment of deposit holders. Next, if at all the reduction in share capital has been done as per the requirement of order passed by tribunal. So in certain situations, the tribunal can order the company to reduce its share capital. In such a situation, auditor needs to ensure whether that copy of order that is given by the tribunal, is it filed with ROC or not. And auditor also should check in this situation whether the compliance with the terms and conditions of the order that has been given by the tribunal has been followed or not. And in some situations, the tribunal will say that, see, your share capital is being reduced now. However, in the balance sheet, you will show reduced share capital. Now, for the next 5 years, in the heading, you, sorry, not for next 5 years, just for that year, in the heading of the balance sheet, you use the term and reduced. so that users will get to know that the share capital of the company has been reduced during the current year. Okay, not for the 5 years, just for the current year you use the term and reduced. See, confirm words and reduced if required by tribunal order has been added in the name of the company in the balance sheet. If let's say the name of the company is A Limited, if at all in any year you have reduced the share capital, for that year in the balance sheet you should use the name of company as A Limited and reduced. Understanding? Yes. Next, check register certificate regarding reduction of share capital. So once you have reduced the share capital, the register or from ROC you need to obtain a certificate, right? From online you can get it. So wherein the reduced share capital will be shown, that you need to see. Next, the presentation with respect to this reduction of share capital has to be made as per the requirement of schedule 3. Check schedule 3 part 1 is complied regarding the presentation of this reduced share capital. Next, confirm whether revaluation of assets has been properly disclosed in the balance sheet. So the assets have been reduced to 50 crores now from 100 rupees. That means you have to revalue it. See, revalue means not always increase in the value. In some situations the value will also reduce. So that reduction in the value of assets revaluation has been properly disclosed in the balance sheet or not, you need to see. And for this reduction of share capital you have to pass entries in the books of accounts. So whether those entries in the books of accounts has been properly passed or not, you need to vouch them. And next, note, nothing in this section shall apply to buyback of company shares under section 68. I told you, for this second situation of buyback there is a separate section number 68. So whatever we have discussed in section 66, that is not applicable for section 68. So additional requirements, separate requirements are there in section number 68. Clear? Yes. Next, disclosures with respect to equity. This is the final concept under the share capital. So what disclosures you need to give in the balance sheet? See, these disclosures are as per schedule 3 of companies act. So number of shares, number and amount of shares authorized, and number of shares issued. So how many number and how much amount of shares is authorized, and of that how many number of shares have been issued. Next, what is the face value of share, par value of share. Next, reconciliation of number of shares outstanding. That means in opening how much share capital is there, and in closing how much share capital is there, reconciliation of that. Next, rights, preferences and restrictions attached to each class of share. I told you there will be different class of share, and for each class of shares there will be different types of rights attached to it. So you need to describe what rights are there for each class of shares. Next, shares in respect of each class in the company held by its holding company. So if at all in your company any shares are held by holding company, that you need to disclose separately. Next, you should also disclose name of shareholders who are holding more than 5% of the shareholdings. Next, shares reserved for issue under options and contracts or commitments should be disclosed separately. So in company what they will do is some shares they will keep aside for the purpose of issuing them as options or for the purpose of issuing them under commitments that the company is having. Next, terms of any securities convertible into equity or preference. Next, if at all there are any unpaid calls means generally company will, whenever it issue shares, it can ask the amount in the form of calls, application money, call 1, call 2, call 3, like this. The company has made call number 2, but some shareholders they haven't yet paid the call amount, that is unpaid calls. Next, forfeited shares means company will see it had made call 2, it will give some time, 15 days or 20 days. Within that time if the shareholder doesn't pay the amount, company will forfeit the share. Understanding? So he would have already paid application money, he would have already paid call number 1 money, so that shares he will forfeit, that amount he will forfeit. Clear? Yes. Next, 5 immediately preceding the financial year. So for the 5 immediately preceding financial years, you need to show number of and class of shares allotted without payment received in cash. So for consideration other than cash, have you allotted any shares in the past 5 years? If yes, disclose. Next, number of and class of shares are fully paid up by way of bonus. So in the past 5 years, if at all you have issued any bonus shares, see, for the bonus shares, the company will utilize the reserves amount. And number of and class of shares bought back. So for the past 5 years, how many and how much amount of shares you have issued for consideration other than cash, how much bonus issue you have made, and how much buyback you have made. These things needs to be disclosed separately. Clear? Yes. Next. So here there is this concept. So there is A Limited, which is our company. Our company, it has given money to intermediary with a understanding that this intermediary should further invest that money in the B Limited. You can ask me, sir, why to give to intermediary and then transfer to B Limited? Directly you can give to B Limited na, because there are certain laws or regulations that are restricting A Limited from transferring money to B Limited. Let's say B Limited is located in some foreign country, and as per that foreign country laws, amount should not come from India. So various reasons might be there, because of which A Limited is not able to directly give the money to B Limited. So in such situation, what it has done, it has given amount to intermediary, from intermediary it has transferred to B Limited. Here we will call A Limited. A Limited is our company. We will call it as funding party because it is giving the money, and intermediary, the name will be intermediary. B Limited will be called as ultimate beneficiary because it is getting benefited ultimately, right? Ultimate beneficiary. Now, if at all in the company, any of these kind of transaction has taken place, company in its balance sheet, in its financial statements, it needs to disclose date and amount on which it is amount is transferred to intermediate. Okay, on which date it is transferred and how much amount. Similarly, date amount of intermediary transferring it to B Limited. Understanding? If at all intermediary is giving any guarantee, instead of direct transfer of fund, it is giving guarantee to be limited, then also date and amount of guarantee, these things needs to be disclosed. Got it? Yes. Next, another situation. In this situation, this is our company A Limited. Okay, we have received money from B Limited. Okay, here B Limited has become funding party, and this is our company. So we are here acting as intermediary. Okay, now we have received the amount with an understanding that we will further give it to some C Limited, which is the ultimate beneficiary. Getting it? So see, the difference is in the first situation we are the funding party, in the second situation we are the intermediary. Here also we need to disclose date and amount received from funding party, and date amount we have further transferred to C Limited. If at all we have given guarantee on behalf of that money, the date and amount of guarantee. Getting it? Yes. So those things you will find here. First situation, second situation. Clear? And finally, you should also disclose declaration that provisions of FEMA compliance, Companies Act and PMLA are compliant. PMLA means Prevention of Money Laundering Act. FEMA means Foreign Exchange Management Act. Understanding? So if at all these provisions has to be, if at all these provisions are applicable, whether these provisions have been complied or not, you need to disclose. Clear? So these four disclosures you need to make in these two situations. Yes. Next. So first part, share capital, is completed. Now we'll move to reserves and surplus. See, reserves and surplus, you can categorize them into revenue reserves, capital reserves. Now what is meant by revenue reserves? See, revenue reserves are those reserves which are freely available for distribution, right? So profits that are available for distribution to shareholders. Now, what are the purposes for which you can use these revenue reserves? You can almost use it for whatever the purpose you wanted. See, supplement divisible profits in lean years. So what is meant by this lean years? See, you have been giving dividend of 10 rupees for the past 4 years, but in the current year, in the fifth year, you are not having sufficient profit to give dividend. But if you don't give dividend, share price might fall down. So what you are doing, you are having reserves. So from that reserves, you are utilizing the money to give dividend in the current year. So lean year means the year in which the amount is or profits are not sufficient to give dividends. In case of such lean years, you can use reserves and surplus for the purpose of giving of dividend. Clear? Yes. Next, strengthen company's financial position. You can use these reserves and surplus for strengthening the company's financial position. Next, if you want to enter into any new businesses, extend the business of the company. For that also you can use. And for augmenting means increasing the working capital of the company. So in order to increase the working capital of the company also, you can use this revenue reserves. So for almost all the purposes, you can use this revenue reserves. Next, coming to capital reserves. These capital reserves, they are not freely available for whatever the purpose you wanted. Okay, there will be certain restrictions. First of all, these capital reserves arises from most 99% of the situations from sale of capital assets. Whatever the profit that you receive, that you will transfer to capital reserves, and these are not readily available for distribution, created from capital profits on sale of capital assets, and can be generally utilized for writing of fictitious assets. Understanding? That is capital reserve, so which are not freely available for utilization. Next, so with respect to these reserves and surplus, what points you need to see? See, just like for share capital, you have tallied the opening balance. Here also you need to see the same thing. Trace and tally opening balance to previous year audited financial statements. This point basically you can use it for all the balance sheet items. So if the question comes with respect to share capital, trade receivable, fixed asset, intangible asset, whatever the question comes with respect to balance sheet items, you can use this point. Okay, trace the opening balance of current year with the closing balance of previous financial year. This point is universal point for all balance sheet items. Next, trace movement in statement of changes in equity. So if at all any addition, deletion has been done to statement of changes in equity, basically in this statement of changes in equity, all the reserves will be there. Okay. Next, verify board of directors resolution to recommendation of dividend and AGM resolution for declaration of dividend. Now, what is the difference between recommendation of dividend, declaration of dividend? See, board of directors will recommend the dividend. See, on recommendation, no liability will arise on the company. Let's say board of directors have recommended a dividend of 10 rupees. Now, shareholders in the AGM will declare the dividend. Once the declaration has been done, then the liability will arise on the company. And this declaration by the shareholders should be equal to or less than 10 rupees, but not more than 10 rupees, because board of directors have recommended only 10 rupees. Clear? That is the difference between declaration and recommendation. So for declaration of dividend, there will be AGM resolution. For recommendation of dividend, there will be board of directors resolution. You need to see that. Next, dividend declared after balance sheet date do not recognize as liability. Understanding? Let's say, for example, on 4th April, the company has declared the dividend. Now, as on 31st March, you should not recognize it as liability, because it is declared. Liability has arisen in the next year. Getting it? Next, securities premium confirm that shares are issued in excess of normal value. Verify utilization is for limited purposes only. We have discussed if at all you have issued shares at a premium, you have to credit that amount to securities premium. You need to see whether amount is credited or not, and that securities premium can be used only for certain restricted purposes, right? Yes. Next, disclosures with respect to reserves and surplus. So this is also as per schedule 3. So how you will disclose? First of all, you will show capital reserves. Next, capital redemption reserve. Capital redemption reserve means, redemption means repayment. Repayment of what? Of capital. So for repayment of capital, if you are maintaining any reserve, that will become capital redemption reserve. Next, securities premium, dividend redemption reserve. Next, revaluation reserve, share option outstanding reserve, other reserves and surplus. So in this manner, you need to present or you need to disclose the reserves and surplus. Got it? So that is discussion about reserves and surplus. Very easy, right? Yes. Now moving to borrowings. So borrowings taken by the company. This is liability for the company. So what are the audit procedures for the borrowings? See, from now onwards, we will be going like this. So for borrowings, what assertions will be there? Existence assertion, completeness assertion, valuation assertion. So with respect to each of these assertion, what audit procedures we have to perform? What is meant by assertion? I already told you, right? Yes. So with respect to existence assertion of borrowings, you need to first of all check the board minutes. So in case of borrowings, there will be certain approval required by the board of directors. Without approval, how can you borrow the money? So whether approval of board of directors is there or not, that's what you will see. Next, now let's say the company shows that we have taken loan from SBI bank 10 crore rupees. Now whether it is actually in existence or not, for that what you will do, you can send external confirmation to the SBI bank, right? So minutes, board minutes, external confirmation. And in case of debentures, see, debentures are also borrowings. In case of debentures, there will be debenture trust. Now you need to examine the trust deed of that debenture trust for the terms and conditions. See, why the debenture trust will be created? See, debenture holders, they are giving you the money as a loan. When they are giving you the money as a loan, will they give the amount without any security? Of course they will ask for a security. But let's say there are 20,000 number of debenture holders. Of course, because debenture holders, debentures value of 10 rupees or 50 rupees or 100 rupees face value will be there. You will sell the debentures to a lot of people. So there are 20,000 debenture holders. Now you cannot register debenture, you cannot register the property security in the name of all the debenture holders individually. So what you will do is you will create a trust, debenture trust, and in that debenture trust all the debenture holders will be members, and you will register the security in the name of debenture trust. There will be certain terms and conditions for this debenture trust that you need to see. And if at all debt is repaid, that means if the borrowing is repaid by the company, okay, company has taken the loan and it has repaid the loan amount. If amount has been repaid, the relevant security should also be discharged. Whether such discharge has been obtained or not, you need to see. Next, with respect to loans that you have taken, there will be agreement. So that agreement also you need to check. Next, check lease and hire purchase creditors with underlying agreements. So you need to go through the agreements with respect to borrowings for getting assurance about the existence of those borrowings. Next, completeness assertion. So with respect to completeness of borrowings, what aspects you will see? First of all, you will ask the company to give me all the list of borrowings that you are having. So obtain schedule of borrowings and trace this with the general ledger balance. Next, if at all there has been any new borrowings that have been taken place, then for taking the new borrowings, discussion will be made in the board meeting. So go through the minutes of board meeting, and in the minutes of board meeting they have discussed that let us take a borrowing of additional 20 crore, but in the books of accounts additional 20 crore borrowing has not been recorded. So you have identified some of the borrowings which are not recorded. So you will get to know about the completeness of the borrowings by going through the board meeting minutes. Next, review subsequent transactions. So subsequent transactions means after 31st March you review some of the transactions. So if let's say for example you are finding after 31st March every month certain payment EMI is deducting with respect to certain loan, but that loan is not there as on 31st March in the books of accounts. So it means that certain incomplete, certain loans have not been recorded in the books of accounts. So you will get to know any loans not recorded in the books of accounts by reviewing subsequent transactions. So this also will help you to identify completeness of borrowings. Next, of course, the easy thing is ask for a direct confirmation. So through direct confirmation also you can get to know whether loans are complete or any incomplete, any loans have not been recorded in the books of accounts. So about what things you can obtain the confirmation. See, confirmation, direct confirmation need not be with respect to amount only. you can ask direct confirmation with respect to existence, with respect to any terms and conditions, getting it. See, balance and for other information you can ask for direct confirmation, and reminders for non-replies. If at all any people have not replied for the direct confirmation that you have sent, you can remind them, follow up, and the amount that is shown in the direct confirmation request, whether it is matching with the books of accounts or not. So compare it with the books of accounts. This is what you will do with respect to completeness. Next, with respect to valuation. See, with respect to valuation of borrowings, first thing that you need to see is what is the accounting policy that they are following. So accounting policies and method of recording the debt, this you need to check. And agree loan balance and payables to loan agreement. So in the loan agreement, how much is the loan amount that is being showing, and in the books of account how much loan they have recognized. So this will also impact the valuation, correct or not. Next, rate of interest. Every month interest amount will be credited to the loan account, right? So how this rate of interest is being calculated, whether it is properly calculated, that also you will check, because this will have impact on the valuation of the borrowing. Next, check computation of amortization of premium or discount. See, amortization means the repayment schedule. So how monthly how much amount you are repaying, this will also impact the valuation of loan amount. Next, in case of any foreign currency loans, then at the end of the year you need to revalue the loan amount as per the closing rate, right? So check closing exchange rates have been used for the revaluation of the loan amount or not, because since loan amount is a balance sheet item, all the balance sheet items should be restated. In case that amount is a foreign exchange amount, then restated at the closing rate. If at P&L items, they need not be restated, because expenditure is at a point of time. So at that point of incurring the expenditure, how much is the rate of conversion, foreign expenditure, how much is the rate of conversion, at that conversion rate you will recognize the expenditure. But balance sheet items are not like that. Okay, yes. Next, some of the other procedures that you will perform with respect to borrowings. So you need to examine the due date. So what is the due date for payment of each month EMI, and this due date is also very much important for calculating short term and long term borrowings. Let's say for example, tenure of loan is 10 years. Even though the tenure of loan is 10 years, the amount that you are going to repay in the coming next 1 year will be considered as short term, and that will be repaid in the remaining 9 months will be considered as long term. So for the purpose of proper classification of loan into short term and long term, you need to give more focus to the due dates. So examine the due dates and reconcile the balance with books of accounts and the passbook, right? Whether both the amounts are matching. If they are not matching, what is the reason why they are not matching? Next, confirm balance with a certificate from the bank. Nothing but a direct confirmation. We have already seen this. This is important point. Installment of long-term loans falling due in next 12 months is properly disclosed as current. Just now I have told you the amount of loan that you will repay in the coming next 12 months should be classified as short term, not long term. Okay, even though the entire tenure of the loan is 10 years or 15 years long term, but of that entire long term loan, how much you are going to repay in the upcoming 12 months, that portion should be classified as short term. Next, if the value of security falls below the loan outstanding, then loan is classified as secured only to the extent of value of security. The remaining portion should be classified as unsecured, and whatever the amount that has been borrowed by the company is within the borrowing limits of the company, because every company in its AOA or in its MOA, it will specify limits that maximum this amount of money can be borrowed. If you want to borrow more than this money, you need to take approval of shareholders. Like this, there will be limitations. Of course, even in section number 180 also there is such a limitation. Company cannot take as much of loan as it wants. There is certain calculation and amount in excess of it. If the company wants to take the loan, it has to get approval of shareholders, right? See section number 180, here only it is there. Company has not contravened the restrictions laid by section number 180, and amount borrowed is within the borrowing powers of the company. Next, disclosures with respect to this borrowings. So disclosures broadly there in the three items you will give. First one, long term borrowings, other long term borrowings, short term borrowings. These long term borrowings, they will be classified as bonds, term loans from banks and others, deferred payment liabilities, deposits, loans and advances from related parties. This point it will be there even in short term also. Long term maturities of finance lease liabilities and other loans and advances. Okay, so this is how you will classify. This is how you will classify long-term loans. Coming to short-term loans, you will classify them as loans repayable on demand. Next, loans and advances from related parties. I told you this is common. Next, deposits and other loans and advances. So this is how you will classify short-term borrowings. Now, coming to the long-term borrowings, you need to subclassify them further as secured and unsecured. Similarly, short-term also you will subclassify as secured and unsecured. Next, aggregate amount of such loans under each head guaranteed by director. So if at all any of these amount is guaranteed by directors, you need to disclose separately under this how much amount is guaranteed by directors. Similarly here also, aggregate amount of such loans guaranteed by directors. Next, bonds, debentures along with the rate of interest and particulars of redemption. This will not be there in short term. Next, terms of repayment of term loans and other loans, and period and amount of continuing default. Here also period and amount of continuing default. If at all you are not repaying the short term loan or the long term loan, what is the period for which you are default and how much amount you are default. And current maturities of long term borrowings. Current maturities of long term borrowings means I told you just in the previous page only. There is a long term borrowing of 10 years. Of that long term borrowing of 10 years, the amount that you are going to repay in the upcoming 12 months, that is current borrowing, you need to classify it separately. So that is short term and long term. And other long term you will classify as trade payables and others. Getting it? Yes. So this is the disclosure with respect to long term borrowings, short term borrowings and complete borrowing. So if you read it by dividing it like this, you will be able to easily remember it. Getting it? Yes. Next, additional regulatory information that has to be given. So with respect to the working capital loan, now what is meant by working capital loan, we have already clearly discussed this while revising bank audit chapter, right? I have told you why working capital loan will be given, on which security working capital loan will be given, right? On the basis of security of inventory and debtors, a working capital loan will be given. So with respect to this working capital loan, the thing that you need to check is, I told you quarterly returns will be submitted by the borrowers to the bank. So whether the amount of inventory, amount of debtors that is shown in the quarterly returns is matching with the books of accounts or not. If you see this point, we have seen in clause 2 of Coro also. If you go to clause 2 of Coro, same point you will find there also. Okay, that needs to be checked by the auditor. And if not, summary of reconciliation and reasons for material disturbances. Next, if the company is declared as a willful defaulter means wantedly that person is not repaying the amount to the bank. Like this, if the bank declares the company like Vijay Mallya, Nirav Modi, so these people, they are willful defaulters. In such a situation, in the balance sheet you need to disclose date of declaration as a willful defaulter and details of defaults. Okay, which amount you have not paid, because of which you have been declared as willful defaulter. Next, whenever you take any loan, and for that loan if you offer security of any of your properties to that bank, charge should be registered against that property, and that charge it will be registered with ROC. So charges yet to be registered with ROC beyond the statutory period, you need to disclose separately. Understand? So with register of companies, you need to register the charge. If at all you have not yet registered the charge but the due date has passed, then you need to disclose this separately. Getting it? So that is with respect to borrowings. So complete discussion of borrowings is also done. Now moving to trade receivables. Trade receivables means debtors. How debtors will arise? Through sales, debtors will arise. right? What will be the assertions with respect to these trade receivables? Existence assertion, completeness assertion, valuation assertion, cutoff assertion, right? See, cutoff is generally related to sales. Since the trade receivable will arise through sales only, cutoff assertion also we will be seeing here. Okay, let us start. So what are certain general considerations that needs to be seen by the auditor with respect to trade receivables? First of all, auditor needs to see whatever the trade receivables that have been shown in the books of accounts, have they occurred because of genuine sales only, or are there any fake sales? So or all the bona fide sales only. Bona fide means genuine, true, real, understanding. Next, whatever the sales that the company has made, that should be made only to approved customers. So if you wanted to give credit to any customer randomly, to any customer you cannot give the credit. You will first of all check his credit worthiness, your relationship with that customer. Only after that you will give credit to that particular customer. So credit sales should be made only to the approved customer, and all the credit sales, they should be properly recorded in the books of accounts, because after the credit period is completed, you have to collect the amount from that particular customer, right? Next, settled only by receipt of cash or on authority. See, whatever the sale that you have made, for that either you should receive cash, or there should be approval of a proper authority for granting the credit. And for this sales transaction, there should be segregation of duties. The complete sale transaction should not be executed by single employee only. Okay, the speaking with the customer should be done by sales department. Next, handing over goods should be done by other person, and collection of payment should be done by other person, and making entries in the books of account should be done by other person. Like this, duties has to be segregated. Getting it? Next, you need to ensure whether amount from the trade receivables has been collected on time, and if at all any trade receivable is not giving the money to you, you have to, you means company has to take proper legal action. So auditor will see whether legal action has been taken properly or not, and regularly review the balances, and a proper system of follow-up exists. So these points you will see with respect to trade receivables, the general considerations that you will see with respect to trade receivables. Next, existence of trade receivables. So with respect to existence of trade receivables, what points you will see? So first of all, you will ask the company to give period end accounts receivable aging report. So you please correct this as aging, aging report means how much is the age of debtors. Age means not the literal age, 56 years, 76 years, not that. So from the time credit sale has been made, for how much time that debtor is outstanding. So outstanding for 30 days, outstanding for 60 days, outstanding for 90 days, outstanding for 120 days, like this aging report will be generated. So you'll ask the company to give that aging report, and whatever the amount has been received from the customer, that has to be adjusted invoice wise in a FIFO basis. So first invoice should be adjusted first, and if any large balances due for a longer time, you need to ask for the reason. That means there is a 1 crore rupee amount receivable from debtor, and that amount is outstanding for the past 1 year. So you need to ask with the management, 1 crore amount outstanding for past 1 year, why you are not taking any step? Is that debtor actually in existence? Okay, so in this situation you will get a doubt over the existence, understanding. So these points you need to verify with respect to existence. Next, with respect to completeness. Now, with respect to completeness of trade receivables, you need to match sales invoice with shipping logs. So there is goods shipped to the customer, but no sales invoice, no entry in the books of accounts. So incomplete sales recorded in the books of accounts, you will get to know. So match the sale invoices with shipping records or shipping log. Next, there will be bill and hold sales. Bill and hold sales means you have billed the customer, but still the stock is with you only. So these kind of sales also you need to assess them carefully, because there is a chance that company would have raised a fake invoice saying that this is a bill and hold sale, in order to increase its sale amount. After 31st March is completed, it will again reverse, cancel that sale, right? So to avoid such a thing, you need to clearly assess the bill and hold sales. Next, check the receiving log, proper process of giving a discount. So if at all any discount is being to the debtors, you need to check what is the policy for giving the discount, whether that policy has been properly followed for giving the discount or any unauthorized discounts are being given, and review credit memos are authorized. See, credit memos means for the debtor you are giving credit memo means a discount. Some in some situations, instead of giving direct discount, what the companies will do is they will give a credit memo, and that credit memo that customer can use if the customer purchases the goods with the company in future, just like a cashback voucher, you can say. Understanding? Yes. Next, cutoff. What is meant by cutoff? See, cutoff assertion says that whatever the transactions that have occurred in the current year, only that has to be recorded in the current period. You should not record previous year transactions in the current year, and you should also not record next year's transactions in the current year. That is cutoff. Clear? So, cutoff with respect to trade receivable means cut off with respect to sales. So check last few invoices to see goods should have been dispatched, and all goods dispatched in the year have been invoiced. So only goods dispatched during the current year should be invoiced and included in the current year. You should not invoice the next year's goods and include it in the current year. Next, no goods dispatched after the year end has been invoiced. So if at all any goods has been dispatched in the next year, that invoice should be raised in the next year, right? Next, valuation of trade receivables. So allowance for doubtful accounts. If at all there is any doubtful account, proper provision for that has to be provided. And you should also ask for aging report. See, this through this aging report, you will get to know how many debtors are outstanding for a long duration of time. If any debtor is outstanding for a long duration of time, there is a high chance that that debtor might become bad debt. So with respect to bad debts, you need to provide provision. So for properly calculating that provision, you need to ask for aging report, and you should also ask the company to give list of debtors which are under litigation. So if the debtors are under litigation means debtor has to give 1 crore rupees, but debtor is saying that I will not give 1 crore rupees, I will give only 70 lakhs rupees. These kind of litigations will be there. That means in case of litigated debtors, valuation of debtors can get affected. So you should ask for litigate debtors in which there are litigations. Next, identify those debtors which appear to be doubtful, because you need to provide provision there. Next, check if provisions are made at appropriate rates, and check that write-offs have been approved by appropriate authority. So if at all any debtor has been written off, the accountant, he should not just write off the debtors as he wanted. There should be approval by the proper authority for writing off the debtors. Similarly, this point you will find even in trade payables. For trade payables, you will not write off, you will write back the trade payables. So if you feel that for any trade payable amount need not be paid, you will write back that amount. So write backs should also be authorized, just like write offs should be authorized, write backs should also be authorized by proper authority. Clear? Yes. Next, with respect to debtors, there is a unique procedure that you will follow, which is nothing but a direct confirmation procedure. Now what points you need to follow in this direct confirmation procedure? Basically, under this direct confirmation procedure, you will directly contact the customer with the written consent of the entity. So if you wanted to contact with the customer directly, you need to ask for written consent from the client. Understanding? If management refuses you to ask written confirmation, you will ask the grounds, what is the valid grounds. Based on that, you will follow the procedure that we have seen in SA 505. Basically, the complete aspects with respect to external confirmation we have seen in SA 505, right? And the confirmation can be requested at the balance sheet date or at some other date, also at any date in between the year. Next, method of selection of trade receivable should not be revealed to the entity. This I have told you while discussing SA 505. If you reveal the entity, how you are going to select the trade receivables, entity will become alert, right? And give the list of trade receivables to the entity to prepare letter of confirmation. I told you letter of confirmation has to be prepared on the letterhead of the entity. If you remember, while discussing evidence chapter SA 705, I told you, because customer doesn't know who the auditor is, customer know only the entity. So if the request is sent from the entity's letterhead, customer will be able to identify and he will reply back. Understanding? If at all there is any discrepancy between the confirmation and the amount shown in the books of accounts, you need to ask the company to investigate and reconcile the same. If at all no reply has been received from that customer for this direct confirmation, you need to perform alternate audit procedure to perform audit evidence. See, all these points we have discussed in which standard 505. Next, in case of related party transaction, you need to ensure that the transaction has taken place at arm's length price. The arm's length price means, what is meant by arm's length price? The price that you will charge from a general unknown customer will be known as arm's length price. The same price you should charge for the related parties also. Understanding? Yes. Next, disclosures with respect to trade receivables. So you need to first of all see whether related party transactions have been properly disclosed, because separate disclosure requirements are applicable for the related party transaction. So if at all any related party transaction is a trade receivable, they should be properly disclosed. Next, trade receivable aging schedule, and this trade receivable should be further subclassified into secured, unsecured, and doubtful. These further subclassification has to be done, and allowance for bad and doubtful should be properly disclosed. So if at all you have provided any provision for bad and doubtful debts, that should be disclosed properly. And the debts due by directors or officers of the company should be disclosed separately. That means director or any officer or employee of the company has purchased goods from the company on credit basis, and he is our trade receivable since he has purchased on credit basis. These kind of things should be disclosed separately, where director or officer of company is a trade receivable of the company. Next, firms or private limited companies in which director or officer, see, any director is a partner or director or a member, then you need to disclose that also separately. That means any partnership firm or any company purchased goods from our company. Okay, this is our company. So from our company, partnership firm or company or any company has purchased goods, and in this partnership firm, our director, okay, in our company, Mr. A is the director. This Mr. A is a partner of this partnership firm, or Mr. A is a director of this company, or Mr. A is a member of this company. In such a situation, these partnership firm and company, which are your debtors, should be disclosed separately. Getting it? Yes. Next, cash and cash equivalence. Under this cash and cash equivalence, first of all, of course, cash will be included, and stamps in hand. Stamp means these stamp papers will be there now, those things, and bank balance will also be considered under this cash and cash equivalence, checks in hand, etc. So all these things will be considered under cash and cash equivalence. So with respect to checking completeness of these cash and cash equivalence, what procedures you will perform? First of all, you need to conduct a surprise check. So without giving any information, you need to visit the company and check the cash and cash equivalent balance. Next, if the company is having more than one cash balances, that is, each branch is having a cash balance and cash balances are there in separate locations, then the verification of cash balance in all the locations should be done simultaneously, because otherwise there is a possibility that company will bring the cash that is present in other location to here, and it will show as cash. The same cash it will take to some other location and show as cash there also. So to avoid that, verification of cash in all the locations should be done simultaneously. Next, at the time of verification of cash, cashier should be there at the location where you are verifying, because there is a possibility that if at all there is any theft of cash, then cashier might say that auditor only taken away the cash at the time of verification. To avoid that, auditor should verify the cash in the presence of cashier. If at all there is any rough cash book that is being maintained, you test check the entries that are made from the rough cash book to the main cash book, whether properly transferred or not. In case of slip chit IOU, slip chit IOU means, let's say for example, any of your subsidiary or any of your known person asks you money for just 2 or 3 days. So within 2 or 3 days, he will again return back to you. So in such a situation, you will give the money to him by taking a slip or a chit or IOU. IOU means, the full form of IOU is IOU only. IOU. So like this, you will take a small slip on it and you will give the money for shorter duration of time. See, these things they will be used only for short duration lending. In this situation, you need to check whether approval by authorized official has been there for this slips, chits, and IOUs. And cash sensitivity analysis should be done, management description for variation. So these procedures you will perform for completeness of cash. And valuation, what valuation you will do for the cash? Everything will be valued in terms of cash. What valuation you will do for the cash? So no valuation will be there for the cash, but if at all there is any foreign currency available with the company, you need to convert that foreign currency into Indian currency at the rate that is there on the closing date. Getting it? Yes. So valuation with respect to foreign currency you will do. Next, some of the disclosures with respect to cash. First of all, cash will be classified as balance with banks, checks, drafts on hand, cash on hand, and others. So in this way, you will classify the cash and cash equivalence. Next, earmarked balance with bank shall be separately stated. Earmarked means you have kept certain money aside for a specific purpose, that you will call as earmarked balances. So such earmarked balances should be kept separately. Next, balances with banks to the extent held as margin money or security, that also you need to disclose. Next, repatriation restriction shall be separately stated. Repatriation means your money there in the foreign country that you want to bring to India, that is repatriation. So if at all there is any repatriation restrictions with respect to any of the cash balances or bank balances, you need to state the repatriation restrictions. Understanding, you need to disclose the repatriation restriction. Next, bank deposits with more than 12 months maturity shall be deposited, shall be disclosed separately, because these will become long term deposits, right? So you need to disclose them separately. Next, bank reconciliation, BRS verification. How will you verify the BRS? First of all, auditor will see whether the BRS has been properly signed by the authorized personnel or not. Next, tally the balance as per bank statement, whether matching or not. If there is a difference, you will see the reasons for difference, right? Next, you need to check the checks that are issued but not presented. Okay, you have issued the check to the customer, but the customer has not yet presented it. You need to uh, see those kind of checks. And in case of stale checks, it is not state, stale, stale. Stale checks means the duration for the check has completed. Generally each check will be valid for a period of 3 months or 90 days. So after that duration of check has been completed, you need to again bring back that amount to the liabilities. Generally, to whom you will give the check? For your trade payables, for your liabilities you will give the check. You have given check to the liability, one of the liabilities. That person has not deposited, time has completed. Now your liability is not yet cleared, so you need to bring back this amount again to the liabilities. Understanding? Yes. Next, checks deposited but not credited, you need to go through them. Checks not created, cleared beyond a reasonable time. See, if you give a check and the customer deposits it, generally within 2 to 3 days the check should be cleared. Nowadays within 1 day it is clearing because of the new check truncation system that has been brought by the RBI. Within 4 to 5 hours the check is getting cleared. So if any check is being not cleared for a long duration of time, 10 days, 15 days is happening, but still the check is not cleared, you need to ask the management why, what's happening here. And charges debited or credited by the bank but not accounted for, this, if this item is presented in the BRS, you need to check that why it has not been accounted for, even though the bank has debited the charges, why the same has not been accounted in the books of accounts. Next, you need to ask direct confirmation. See, contact bank or financial institution directly and ask them to confirm the amount that is present and investigate and reconcile the discrepancies. So if the bank is saying that the amount present in the company's bank account is 1 crore rupees, but in the company's books of accounts it is showing as 1.5 crore rupees, what is the reason? Discrepancy should be checked. And emphasize, you need to ensure that 100% of bank balance should be confirmed. Let's say for example entity is having 6 bank accounts, So you should get confirmation from all the 6 bank accounts. It is not that in 4 bank accounts huge amount is there, so you have taken confirmation only from that 4 banks, 2 banks only small amount is there, you haven't asked for the confirmation. No, in case of bank accounts you should go for 100% confirmation. Getting it? Yes. So that is with respect to cash and cash equivalents. Next, going to inventories. Now what is meant by inventory? See, inventories are those assets which are held for sale in the ordinary course of business, nothing but finished goods, or the assets which are in the process of production for such sale, nothing but work in progress, and in the form of material to be consumed in the production process, nothing but raw material. All these they come under inventory, right? So with respect to existence of inventory, what things you will see? First of all, what is the plan that the entity has made for physical verification of the inventory? You need to evaluate the entity's plan for inventory verification. And with respect to goods that are sent on a consignment basis, you need to see whether proper segregation has been done or not. And in the physical inventory verification of goods that the entity will do, auditor should also participate in that physical inventory verification. Next, auditor should see which type of records the entity is maintaining for inventory, whether they are maintaining periodic system or perpetual system. What is meant by periodic system and perpetual system? See, under perpetual system of inventory, what happens is the entries in the inventory records will be entered on a real time basis. So as and when the transaction occurred, the update entry will be passed in the books of accounts, that you will call as perpetual system. In case of periodic system, what happens is after the transaction takes place, once in every 15 days or 10 days, all the transactions will be passed in the books at a time, that is periodic. So if the entity is following periodic system, the books of accounts will not be updated at all the times. But if the entity follows perpetual system, books of accounts will be updated at all the time. So you need to see which type of system the entity is following, because based on that only you will verify the books of accounts. Next, in case the inventory is lying with a third party, you should ask for confirmation from that third party, right? Bank, the external confirmation from the third party. See, third party is a inventory really available with you, like this you should ask for a confirmation. And test account of inventory by auditor shall include. See, I told you, auditor, when he goes for physical inventory verification, he needs to count the inventory on a test account basis. Yes, management, the employees of the company, they will perform counting, but auditor also, he himself on a test basis should perform certain test account. So during such a test account, what points needs to be considered by the auditor? So you need to observe whether employees are properly adhering, following the plan that has been given, and whether items are properly tagged. So for each and every inventory item, there will be a tagging that will be done. So further to tag the price of inventory, there will be basically a QR code will be there on that tag. If you scan that QR code, you will get what type of inventory it is, when it was purchased, and what is the value of inventory, what is the quantity, all these things you will get. So whether that tagging is done properly or not, you should see, and proper amounts should be shown on the tags. You will see, the auditor should see whether proper amounts are shown on the tags that are kept for the inventories. And auditors should stay alert and be cautious for empty boxes, because what happens is the inventory, it will be kept in the form of boxes. So based on the type of inventory, different types of boxes they will use. So in each box there will be inventories, some 20 items, 30 items of inventories they will keep. So now what the employees they will do, they will count each box. So if boxes are 100 boxes, in each box 30 items, 300 items, like this they will count. Now auditor should ensure that all the boxes should contain inventory. If there are any empty boxes that have been kept by the company, and in that empty boxes no inventory is there, but the employees are counting them, audit should do identify these kind of situations. And accounting of all stock sheets, auditor should obtain, and appropriate supervision should be there. So auditor should supervise the employees who are doing this inventory verification. Next, reconcile test accounts with tags and summary sheets. Execution of exclusion of third party stock. So if with the company any of the stock related to third party other person is available, that should not be taken into books of accounts of our company, because that stock belongs to some other person. So that third party stock should be excluded, right? Yes. Next, completeness. See, with respect to completeness of inventory, mostly you will perform analytical procedures. Okay, analytical procedures such as inventory turnover ratio. TO means turnover ratio. Next, inventory by total assets and compare budgets and actuals. You will perform purchase and sales cutoff, because inventory, the amount of inventory, it depends on purchases and sales also, right? So you will also once verify the purchase and sales. And tagged inventory, test for omitted and invalid transactions. Reconcile physical inventory with perpetual records. So with the books of accounts, whatever the inventory that is showing in the books of accounts, is it matching with the inventory that is physically present? So whether complete inventory that is physically present is shown in the books of accounts or not. Next, reconcile inventories belonging to client but held with third party. So the similar point which we have already seen. Next, examine non-financial information. Here non-financial information means number of items of inventory, quantity of inventory, all this is non-financial item, right? Next, clerical and arithmetical accuracy of inventory listing. All these things you will cover under completeness assertion of inventory. Next, ownership rights. So with respect to ownership, you need to check whether inventory has been purchased in the name of company. So in the vouchers, in the bills, the name of the company, in the purchase bills of inventory, name of the company should be shown, right? Voucher recorded purchases, evaluate consigned goods, client correspondence, sales receivable record. So once you need to correspond with the clients whether actually goods have been purchased. And existence of collateral agreements, you need to review consignment agreements, purchase commitment agreements, and invoices for evidence of ownership, because in the invoice only you will get to know whether the inventory is purchased in the name of company or not. Next, obtain confirmation for significant inventory item, inventory held by third party. If you see this inventory held by third party, it is being repeated in almost all the assertions, right? Yes. Next, valuation of inventory. How will you value inventory? Generally, the raw material you will value based on the cost of items that are included in the raw material. So with respect to raw material, you have to see what elements of cost are included in the valuation of raw material. If standard costs are used, compared with the actual cost, this concept of standard cost you will be seeing in the costing, right? Next, test check cost prices with purchase invoices. So at what price you have purchased this particular raw material, that will be shown in the invoice, purchase invoice, right? So you need to once check whether the price that is shown in the purchase invoice at the same price it is being shown in the books of accounts or not. Next, in case of damaged inventory, you will not value the damaged inventory at a cost only, right? You will value the damaged inventory at a realistic net realizable value. So if you sell this damaged inventory as it is, how much you are going to get at that price, you will value the damaged inventory. Next, work in progress. With respect to valuation of work in progress, also auditor needs to see what elements of cost have been included in the work in progress, and what are the various stages that are there in the work in progress, and is there any abnormal wastage factors. These things auditor will consider for valuation of work in progress. And finished goods, of course, the finished goods will be valued at cost or NRA, whichever is lower, right? Yes. And what costs are included in the valuation of finished goods, that you need to see with respect to disclosures. So inventory has to be classified as the first of all raw material, work in progress, finished goods, stock in trade, and stores and spares, loose tools, and others. Stock in trade means stock that you have sent to the customer on sale or return basis, and stock that is lying with the customers on consignment basis. All this comes under stock and trade. Next, whether goods in transit have been disclosed separately under each of a subhead of inventory. So if at all any goods is in transit as on 31st March, that should be shown separately for each item. Okay, raw material, how much goods in transit, work in progress, how much goods in transit, finished goods, how much goods in transit. Like this, for each classification you should separately show how much goods in is in transit. Next, mode of valuation shall be stated. So you need to disclose how you have valued the inventory, right? Next, With respect to absolute inventory, you need to compare recorded cost with the replacement cost. Replacement cost means if you purchase the same item in the market, at how much price you are going to get. Reduce the uh, realizable value by selling this damaged good. See, actual value of good is 100 rupees, but it has got damaged. So if you sell this in the market, you will get only 10 rupees. Okay. Now if you purchase the original good, it will cost 100 rupees. So to replace this, you will have to incur 90 rupees, right? 100 minus 10 rupees. So this is the replacement cost. Next, test overhead allocation rates. Overhead means overhead expenditure like rental expenditure, transport expenditure, salaries, all these comes under overhead. So how much overheads you are allocating to absolute inventory. Verify correct application of lower of cost or net realizable value basis. So this is the disclosure requirement with respect to inventory. Next, property, plant and equipment. So property, plant and equipment means nothing but your fixed asset, right? So first of all, for recognizing an item as a property, plant and equipment, there should be certain recognition criteria that has to be satisfied. So what is that recognition criteria? We will see. First of all, it is probable that future economic benefits will flow to the entity because of that particular asset, and the cost of item can be measured reliably. You are able to easily identify cost of item. Only if these two conditions are satisfied, you can recognize it as PPE. Next, measurement at recognition. So at the point of time of recognition, at what value you will recognize a PPE at. So first of all, purchase price, you will add it, you will recognize it, plus taxes also you will add, and deducting any discounts. If at all you have any received any discounts, that you will reduce from the value of PPE, right? Next, all the costs that you have incurred to bring the asset to its working position to correct current location, all that also you will add to the cost of asset. Next, in case of some type of assets, after the useful life is completed, you need to dismantle it, and you need to clean up the area where the asset has been set up. So in case this asset requires such kind of dismantling, cost of dismantling and removing the item will also be added to the cost of asset, and at this price the value of asset will be recognized at the time of recognition. Next, audit procedures that you will perform with respect to existence of a PPE. See, with respect to existence, the main thing is management will perform a physical verification, right? So what is the plan of management for, performing this physical verification? You need to review it, and you need to appropriately supervise those performing the physical verification. Just like for the inventory, physical verification will be done, even for the PPE also physical verification will be done. Auditor should be present at the physical verification of the PPE and obtain PPE physical verification report. Once that physical verification of PPE is completed, you need to obtain that physical verification report so that you can keep it as a evidence. Next, with respect to completeness of PPE, you need to once go through the PPE schedule. So what movements are taking place in the PPE schedule? Movements means nothing but additions and deletions. So movements in PPE schedule, and tally the closing balance to the entity books of accounts. Next, arithmetical accuracy of movements in PPE schedule. Arithmetical accuracy means if you have purchased a new asset, addition will be there, whether addition made it properly. If you have sold the fixed asset, deletion, whether it is made properly, the entry made properly, that is arithmetical accuracy you will see. Next, whether all the cost have been included. Here we have seen the things that should be included for the valuation of PV, whether all of them have been included, and whether cost is calculated as per AS10 accounting standard 10. Next, you should also check the purchase invoice. So for the purchase of PPE, there will be invoice, right? So check purchase invoice to verify date of addition, because if the date of addition falls in this year, you will recognize it in this year. If it belongs to next year, you should not recognize it in current year, right? Next, PPE addition. So whatever the property, plant and equipment that the company wants to purchase, it needs to be authorized by proper officer. right? So you need to check whether proper authorizations are there or not, and reasons and rationales for deletion. If at all company has sold any of the PPE, what is the reason for selling the PPE, and is there proper business rationale for selling those PPE, that you will see. Next, with respect to valuation of PPE, see, the first point that you will see with respect to valuation is whether depreciation has been properly charged on all the items or not, and what is the method of depreciation that they are following, and the method of depreciation that you follow should reflect the pattern in which assets future economic benefits will be generated by the entity. In that manner, the method of depreciation should be selected. So the way in which you charge the depreciation should simultaneously reflect the way in which the entity generates benefits out of that asset. And if at all there is any impairment, it is not impairment, it is impairment. So whether impairment assessment of the asset has been done as per AS28. Generally every year impairment assessment has to be done. What is meant by impairment? See, depreciation you will charge it every year, because as the effects of time, certain amount of value of asset will fall down. But if there is a drastic reduction in value of asset, like 50%, 60%, 70% of value of asset has fallen, in such a situation you will straight away provide this impairment. You will not provide depreciation, understanding for that particular year. See, along with the depreciation, you will provide impairment to bring the value of asset to the correct value. Getting it? Yes. Next, rights and obligations over the asset. So, entity is showing that in the fixed asset, 2 crore they have shown in the balance sheet. Now, whether entity actually has a right, ownership right over that asset, for that what you will see? You will see the purchase invoice. So, whether the purchase invoice of that particular asset is in the name of the entity, and for land and buildings you will see title deeds. Verify the title deed. You will have to verify the original title deeds, understanding original title deeds. And if original title deeds are with lender, like company has taken a loan, for that loan it has offered the land as security. So when you offer the land as security, you have to deposit the title deeds with the bank. In such a situation where the original title deeds are not available with the entity, you need to ask the confirmation from the bank, understanding? Yes, whether these title deeds are actually available with you. Like this, you should ask a confirmation from the bank, and verify register of charges. From where you can verify register of charges? From MCA website. Clear? Yes. Next, disclosures with respect to property, plant and equipment. First of all, classification. You will classify property, plant and equipment as first land, next building, plant and equipment, furniture and fixtures, vehicles, office equipment and others. So in these areas you will classify. Like this you will classify property, plant and equipment. Next, assets under lease shall be separately specified under each class of asset, and you should show a reconciliation between opening balance and closing balance, and additions and deletions made during the year. Like this a reconciliation you have to show. Next, if at all during the year any sums have been overvalued, not overvalued, revalued. Okay, if you have revalued the asset during the year, okay, there is a increase in value of asset taken place or a decrease in value of asset taken place. In such a situation, for the next 5 years you have to disclose how much increase or decrease in the value of asset has taken place, and in which year you have increased or decreased the value of asset. Okay, so for the first 5 years subsequent to the date of such reduction or increase in the value of asset, you need to give this disclosure. See, this disclosure is there, na, these two disclosures, it will be there even for intangible assets also. So if you go to intangible assets, here also you will find the same disclosures. Okay, here you change it as intangible asset. Clear? Yes. So PPE is completed. Discussion with respect to property, plant and equipment is done. Now moving to intangible asset. So what is meant by intangible? You cannot feel it, right? So intangible asset is identifiable non-monetary asset. Non-monetary asset means it is not readily convertible into cash. So intangible asset is a non-monetary asset without physical substance. It will not have any physical substance, and it is being used in the business, see, held for use in the production supply of goods or services. So this is the definition of intangible asset. So for recognition of intangible asset also, there is certain criteria that needs to be fulfilled. Okay, this is the criteria. If this criteria is fulfilled, you can recognize it as a intangible asset. Next, with respect to completeness of intangible asset, what points you will see? See, these points, they will be similar to that of PPE. You will go through additions, deletions made in the schedule of intangible asset and arithmetical accuracy of those movements. These 2 points we have seen even for PPE also, right? And for additions that have been made during the period, you will see whether recognition criteria as per yes 26 has been met or not. Okay, this recognition criteria has to be met. And research expenditure, this is important. You should not treat research expenditure as a intangible asset. And additions have been approved by appropriate personnel. Of course, for PPA also we have seen this. If you want to acquire any new PPA or any new intangible asset, that should be authorized by appropriate personnel, and there should be proper internal process and procedure for acquisition of this intangible assets. Understanding? And for existence of intangible assets, see, for PPE existence, you can conduct physical inventory, physical verification. But for intangible assets, you cannot physically see it. So physical verification cannot be conducted for existence of intangible asset. Here, what you will see is you will check whether this intangible asset is actively used in the business. If it is actively used in the business, then you will get evidence about the existence. If it is not actively used in business, then it means that it is not in existence. Understanding? So since it has no physical substance, check whether actively used in the production, supply, for rent or other administrative purposes. Next, valuation. Value of asset may be diminished due to the effects of time. So just like you will provide depreciation for PP, property, plant and equipment, you will provide amortization for intangible asset. Okay, amortization is similar to that of depreciation. Next, amortization method that has been used should reflect the pattern in which entity generates revenue from that intangible assets, similar to that of PPE depreciation, right? And impairment also, impairment testing should also be done as per 28 AS 28. Clear? Yes. Next, disclosure with respect to intangible asset. You will classify intangible asset as firstly goodwill, brands, trademarks, computer software, mastheads and published titles. Mastheads means there will be titles now, like subtitles will be there. There will be name of company, and for that name of company there will be a line, a short catchy line will be there, that will be mastheads. Understanding? Next, mining rights, copyrights and patents and other intellectual property rights, services and operating rights, recipes, formula, models, designs, prototypes, licenses and franchises, others. So into these categories you will classify the intangible assets. So that is the discussion with respect to intangible assets. Now moving to trade payables. So this trade payables, it will be similar to that of trade receivable discussion. See, with respect to existence of trade payables, you need to see whether controls are there with respect to purchase and expenses, because trade payables will arise from credit purchases, right? So there should not be any fake purchases out of which trade payable arises. So you need to ensure proper controls are there and obtain accounts payable aging report. Just like you will obtain trade receivable aging report, you will also obtain here accounts payable aging report. Next, with respect to completeness of trade payables, the same procedures that we have seen for completeness of trade receivables. Okay, cut off procedure for the last 5 days invoices. All goods received prior to year end should be booked as purchases, right? Next, test sample purchase to see whether they are correctly recorded or not. Match purchase invoice dates to gate entry dates, because only those purchases that are made in the current year should be recorded in the current year. That's why. Next, review subsequent expenditure vouchers, advance received from the customer. See, if any of your customer gives you advance, that also become trade payable, right? So customer wise aging you need to perform. Next, in case of statutory dues, prepare reasonability with sales. Let's say, for example, GST liability, which you have to pay to the government, is a statutory due. This GST liability, of course, it is a trade payable, right? And you have to establish a reasonability of GST liability. How you can establish? Based on sales. So, if during the year entity has made sales of 10 crore rupees, and for the product which the entity sells, rate of GST is 18%, then how much should be the GST liability? 1.8 crore. So, reasonable GST liability should be 1.8 crore. Like this, reasonability test you should perform. Next, complete list of all statutory dues as per clause 7 of CORO 2020 we have seen for CORO 2020 reporting, right? Yes. Next, valuation. Valuation of trade payables. Old credit or balance need to be written back. I told you, trade receivables will be written off, trade payables will be written back. So for writing back the trade payables, you require authorization from proper authority. So whether proper authority has authorized or not. Next, aging of payable balance and a list of vendors with dispute. See, if at all there is any dispute with the vendor, then the amount that you will pay to that vendor will reduce. So valuation will get affected. With respect to write back, approved by authorized person. Next, if at all the trade payable is to foreign party, for the foreign party you will pay in foreign currency, right? So the foreign currency exchange rate, it keeps on changing, right? So as on 31st March you need to revalue, restate the amount that you have to pay to foreign trade payables as per the exchange rate as on 31st March. Got it? So whether that has been properly done as per accounting standard 11 or not, you will see. Next, amounts due to MSMEs. Understand management process to identify the dues that are payable to MSMEs, because with respect to MSMEs, micro, small and medium enterprises, the requirement is that if any company purchases goods from the MSMEs on a credit basis, the amount has to be paid off to the MSMEs within 45 days. If you don't pay the amount to MSMEs within 45 days, you have to pay interest also on that amount at a rate of 18% interest you should pay. Understanding? So this is the requirement of MSME Act. So see, disclosures relating to MSME trade payables, principal amount and the interest due thereon. I told you, if at all you don't repay the amount within 45 days, there will be interest also. How much principal amount is due, how much interest amount is due, you need to disclose that. Next, interest paid in terms of section 16 of the MSME Act. So during the year, how much interest you have paid to the MSMEs, and how much interest is due but not paid. Okay, how much interest is paid, how much interest is yet to be paid, and amount of interest accrued and remaining unpaid at the end of each accounting year, and further interest remaining due and payable even in the succeeding year. See, even in the, not only for the current year, even in the upcoming years also, if this interest you have not paid, that should be shown in the succeeding years also. You need to disclose that this much amount of interest is outstanding from the past 2 years or 1 year or 3 years. Getting it? Yes. So these are the disclosures that you will make with respect to MSME trade payables. Next, loans and advances and other current assets. See, these are the loans and advances given by the company. Understanding? So, loans, advances and other current assets. These includes loans, advances to related parties, security deposits, capital advances, amount recoverable in cash in kind. All these things will get covered under this aspect. Now, with respect to existence of loans and advances, what procedure you will perform? The most famous procedure, direct confirmation, right? So you can ask for direct confirmation with respect to that borrower, what is the amount of loan that you have borrowed, so principal amount and interest receivable. Next, with respect to valuation, so with respect to valuation, you need to assess how much allowance for doubtful debt is made. So whenever you have given a loan, that person he might repay you, he might not repay you. So if at all there is any doubtfulness, you have to provide a provision for doubtful debt that will impact the valuation, right? Next, aging report of loan and advance you need to take. So if that loan or advance is outstanding for a long duration of time, then you might have to provide more provision on that, correct or not. Next, you need to identify whether any other loans will be or looking like a doubtful. If they are doubtful, then again provision has to be provided, right? Assess bad loans and advance written offs. So if at all any loan has become bad, you need to write off that. So this will also impact the valuation. Any loan has to be written off, but you are not writing it off, so more value you are showing in the books of accounts. Next, whatever the write-offs that you are making, that should be of course approved by authorized personnel, right? Without authorization you should not write off. And in case loans are given in foreign currency, restatement of that loan has to be done as per AS 11 as on the date of balance sheet date. So this restatement point, it is repeating in lot of things, right? Restatement one, write-offs and allowances. This is getting repeated in trade payables, so trade receivables, so loans and advances taken, loans and advances given, in all these things. These points they get repeated. Next, with respect to completeness, so first of all you will ask the company to give me all the list of loans and advances that you have given, and you will compare that list with the books of accounts. Got it? Next, whenever you are giving a loan, there will be loan agreement or not. So you will once go through the loan agreement, and whether the company's MOA and AOA have authorized the company to give the loan, that also you will see authorized by MOA and AOA, and verify loan agreements. Next, whether it is within the competence of the person who has advanced it. So in case of company to give loan to any other person, power will not be there with all the people, only certain people will be given such power. So whether only authorized person has granted the loan or not. Next, minutes of meetings of board you will verify, because discussion with respect to giving loan will be made in the meetings, so that minutes you will verify. And verify that loan is acknowledged by the third party, the party who is taking the amount. Basically you will ask for a confirmation request. And related party loans should be properly authorized and balance with statutory authority. So if at all there is any balance that is lying with the statutory authorities like GST department or income tax department, you need to check the reasonability with respect to purchase or expenditure. So let's say for example GST department, input tax credit lying with the GST department. Now that input tax credit, it will be dependent or directly related to the purchases that you make, correct? Let's say you have made purchase of 1 crore. On average, on your purchases, rate of GST is 18%. So some 18 lakhs should be GST input balance available with the department on your behalf, right? So if it is 18 lakhs or 17 lakhs, it is reasonable. So such a reasonableness test also you need to perform, and obtain statutory return filed with the authorities. So you will file income tax returns, GST returns. So with respect to whatever the amount you are verifying, the respective returns that have been filed, you need to ask for the ask with the company. Next, disclosures with respect to loans and advances given. Here broadly it will be two: long term loans and advances, short term loans and advances. If you see, if you remember one disclosure, the disclosure to other is similar. See, for long term disclosure, it will be classified as capital advance, loans and advance to related party, other loans and advances. Short term classified as loans and advance to related party, others. Only the first one is not there, capital advances, because whatever the amount you give for capital purposes, like mostly will be long term loans, right? So capital expenditure means construction of factory or purchase of any fixed asset. The tenure for such type of loans will be more, so that the type of loans won't be there in the short term, they automatically becomes a long term, right? Next, these long term loans, they should be again subclassified into secured, unsecured, doubtful. Short term also same, secured, unsecured, doubtful. Next, allowance for bad and doubtful loans and advances shall be disclosed under relevant heads separately. Here also, allowance for bad and doubtful debts, that is provision for bad and doubtful debts. If you have provided, that should be disclosed separately. Same things. Next, loans and advances due by directors or officers of the company, disclose separately. And loans and advances due by any firm or private company in which director is a partner or the member or the director of that particular company should be disclosed separately. Same here also, director, officer, firm and private company. Clear? So this disclosure with respect to loans and advances given is simple, right? Yeah. Next, provisions and contingent liabilities. So first of all, you need to understand what is meant by provision, what is meant by contingent liability. So provision, in case of provision, there will be present liability that will be there on the entity. So entity is liable to pay the amount, but the actual amount cannot be determined. You can determine the actual amount only based on estimation. Then you will create provision. See, provision is a liability. It is a liability. You have to pay the amount, which can be measured only by using a substantial degree of estimation. But actual amount that has to be paid is not known to you yet, which can be estimated. Only estimation can be made, but you have to pay the amount. That for that you will provide a provision. A provision is recognized when entity is having present obligation to pay the amount as a result of a past event, but it is probable that, and it is also probable, okay, not but, and it is also probable that outflow of resources will be required, but here but a reliable estimation can be made of the amount of obligation. You cannot exactly say how much amount, you can only make a reliable estimation. Then you will have to provide the provision. This is a recognition criteria for provision. Next, contingent liability. So contingent liability, first of all, it is not a present obligation. Okay, it is a possible obligation that arises from the past events and whose existence will be confirmed only by occurrence or non-occurrence of one or more of the uncertain future events not wholly within the control of the entity. So there is no present obligation, but obligation might arise in the future or might not arise in the future. That you will call it as contingent liability. Or another definition is, a present obligation is there, okay, arises from the past event, but it is not recognized because it is not probable that outflow of resources embodying economic benefits will be required to settle the obligation, or amount of obligation cannot be measured sufficiently reliable. That means if this condition or this condition, any of that condition or both the conditions are not satisfied, then instead of creating a provision, you will treat it as contingent liability. Understanding? Yes. So from the definition of a provision only, you can derive the definition of contingent liability. Okay, if any of these two conditions are not satisfied, then you will treat it as contingent liability instead of creating a provision. Next, with respect to existence and the completeness of these provisions and the contingent liabilities, you need to first of all obtain from the company all the list of provisions and compare them with the balances in the ledgers, right? So this is the common procedure that you will perform for almost all the balance sheet items. Next, inspect the underlying agreements and obtain a underlying working and basis for each of the provisions. See, for provisions there will be calculations that will be involved, like gratuity provisions, income tax provision. There will be separate calculations will be there, separate calculation sheet will be there. So you need to ask the company to provide that calculation sheet with respect to all the provisions that the company has made in the books of accounts. Next, valuation. So with respect to valuation of provisions, generally experts will be involved, because chartered accountant, he will not be having that much knowledge to determine the actual amount of provision. Income tax provision, okay, you can know, but gratuity provision, in that area the experts will be required. So obtain experts report, calculation and underlying work for the provision amount. If management has used management's expert and auditor decides to use the work of same management's expert, if you remember, we have seen this concept in SA 500, using the work of a management expert. Once you can go to SA 500 and see this concept, you will find using the work of management expert. Now when auditor decides to use the work of management expert, three things he needs to observe. First of all, is that expert having proper competence and capability, knowledge to do that work, right? Next, you need to understand the work that is performed by that particular expert. So how he has performed that work, you need to understand it. The third one is, okay, he has performed the work and he is having knowledge also, but is that work required for me? Is that work appropriate for me? Will it be useful for me? Only if it is useful for me I will use, otherwise why will I use the work of a management expert, right? So whenever you decide to use the work of management expert, you need to see these three things. Next, obtain written representation from the management that it has made all provisions which were required to be made. Got it? Yes. Next, disclosure with respect to provisions and contingent liabilities. So here we have disclosures as per Schedule 3 of the Companies Act and disclosures as per AS 29, provisions, contingent liabilities and contingent assets. So as per Schedule 3, you need to give disclosures with respect to long-term provisions, short-term provisions. See, long-term provisions, provision for employee benefits, others. Short-term also same, provision for employee benefits and others. Next, with respect to contingent liabilities as per Schedule 3, claims against the company not acknowledged as debt. So someone is claiming that company has to pay certain amount to them, but company is not recognizing it as a debt. That is a contingent liability. Next, guarantees, any guarantees given by the company, and other money for which a company is contingently liable. So these three company needs to disclose under contingent liability. And commitments, with respect to commitments, estimated amount of contract remaining to be executed, uncalled liability on shares and other investments partly paid, and other commitments. Getting it? Next, with respect to disclosure as per AS 29, here see, for each class of provision, enterprise need to disclose what is the opening balance. Next, what is the additional provision made during the year. Next, how much provision is used during the year and how much provision is reversed during the year, and what is the nature of that particular provision and expected timing. Okay, at what time you might have to incur that liability for which you have made the provision now, and is there any uncertainty with respect to this timing? Okay, so you are saying that you will use that provision within next 3 months. Is there any uncertainty? Is it possible that you might take 1 more month extra or 2 more month extra for utilizing that provision? So like that, uncertainties, are there any uncertainties? Next, amount of any expected reimbursement. So you have made a provision of 2 crores, meaning that you have to expend 2 crore rupees. Once you expend these 2 crore rupees, will you get any reimbursement? You need to see that also, you need to disclose that also. Generally this will happen in case of uh, if you are exporting any goods to the foreign country, then government will give cashback of the export duties that you have paid, or the import when you are importing and that imported goods you have manufactured in India and exporting, then whatever the import duty that you have paid, that will be again reimbursed by the government because you are exporting, right? So you have imported the goods, while importing you will pay duty, right? Custom duty you will pay. Now that goods you have manufactured in India and the same goods you are exporting, so at the time of exporting, since see, whenever you are exporting, government will encourage you because exports will get foreign currency to the country. Foreign currency is very much important to the country, so government will encourage you. So as a encouragement, it will give back the duty that you have paid at the time of import. So like that, those type of reimbursement will you get for the provisions that you have made. You need to disclose them separately. Understanding? Yes. Next, Binami properties, details of Binami property. See, this details of Binami property is also very important. So Binami property important, even these provisions and contingencies also very important. There is a high chance of asking questions from provisions, contingencies and Binami transactions. So what is meant by Binami property? So let's say there is a particular land. Now Mr. A has paid the amount to purchase the land, but that land is registered in the name of Mr. B. Okay, so payment is made by one person, but the ownership is registered in the name of other person. This you will call it as Binami transaction. These Binami transactions are prohibited. These are illegal. So with respect to Binami transactions, what the company needs to disclose. See, any proceedings have been initiated or pending against the company under prevention of prohibition of a Binami transaction. So company needs to disclose during the year or as on date are there any proceedings pending against the company under this Binami under this prohibition of Binami Property Transaction Act? If yes, details of such a property, amount involved, details of beneficiary. Beneficiary means the person in whose name the property is registered. Sorry, beneficiary means the person who has paid the amount is beneficiary. The person in whose name property is registered, he will become Binami Dar. Okay, he is Binami Dar. Mr. A is the ultimate beneficiary. Okay, so who is such ultimate beneficiary? And if item is recognized in the books of accounts, reference to the balance sheet where that property which is involved under Binomi transaction is recognized. If the property is not recognized in the books of accounts, see, if item is not recognized in the books of accounts, state the fact why it is not recognized. If proceedings are pending, still state the fact that proceedings are pending, and nature of proceedings, status of same, and company's view on the same, whether company will win that proceeding or company will lose that proceeding. So what is the company's view? Next, ratios. All the following ratios should be disclosed. So whatever the ratio, okay, all these ratios should be disclosed in the financial statements. Got it? So now we have completed all the discussion with respect to balance sheet side. Clear? Now moving to P&L items. So in the P&L items, the first major thing will be sales, right? So what audit procedures the auditor will perform with respect to sales? Let us see. First of all, with respect to sales cycle. Now, what is the sales cycle? From the time you sell the goods to customer till the time you receive money to the money from the customer, this entire cycle will be sales cycle. Now auditor has to see whether there are proper controls in this sales cycle. See, sales and collection cycle set of process that begin when customer purchases, ends when entity receives a payment. Test the controls are properly there in this area or not. Next, as per SA 315, it is specifically said that ROMM, risk of material misstatement in the area of sales, is very high. So, auditor needs to give special focus to the area of sales or the revenue, because the ROMM is very high in the area of sales. Next, auditor needs to understand the organization and its revenue centers. Now, what is meant by revenue centers? The areas through which organization is generating money, they will be known as revenue centers. Auditor needs to understand all the revenue centers, and he needs to substantively audit all the sales. Substantively means a detailed audit procedure, test of details, test of transactions, right? Next, understand management's controls in respect of sales. So with respect to area of sales, what controls are implemented by the management, those needs to be understood by the auditor. Next, to verify completeness of sales, that means whether all the sales that have occurred during the year have been properly recorded in the books of accounts or not. For that, you need to first of all perform cut-off procedure, right? Next, specific attention should be given to date of sale of invoice. So date of sale you need to give more focus, because if date of sale falls in the next year, you should not recognize it as sales in the current year. If date of sale is falling in the current year, you should not recognize it in the next year. So you need to give specific attention to date. Okay, next, credit notes that are issued after the accounting period, you should also give attention to these things. Next, trace shipping. See, it is not does docs. So trace shipping documents to sales journal. So once you have passed a sale entry, the respective goods should be shipped, the shipping journal, so both should be matched. Next, verify GST returns. So whatever the GST, whatever the sales that you have shown in the GST returns, they should be properly recorded in the books of accounts. Next, check reconciliation of total sales or goods dispatched as per stock record. So these procedures you will perform with respect to ensuring a completeness of sales. Next, with respect to measurement of sales, you have to trace few transactions from beginning to completion of the transaction. You have to select a certain huge sales invoice and verify those sales invoice completely from beginning to end of the process. Next, if at all client is involved in exports, if your client is exporting the goods, then foreign exchange will be involved. Whenever foreign exchange is involved, you need to apply the requirement of AS 11, right? Next, auditor, he should also understand generally accepted accounting policies that the client is following, and compare rate of sales affected with related party and review collectability. So if entity is selling goods to related parties, you need to see what is the rate of sales sold to related parties. That means of the total sales sold, of the total sales, how much percentage of sale is made to related party, and whether sale made to related party, is it recoverable, can the entity receive money from that related parties, that you need to see with respect to measurement. Next, coming to occurrence. So auditor, he needs to ensure that revenue is not overstated. That means whatever the sales that have actually occurred, only those sales have been disclosed, presented. No extra sales should be presented. So for that, you should see that one sale invoice is entered in the books of accounts only once. So check that none of the invoice is entered twice. Next, test check a few invoices with relevant entries in the sales journal, and you should also obtain confirmation from some of the customers to see whether actually sale of goods has been made to them or not. And if at all there is any fictitious customers, you have to see whether entity has entered any fictitious customers in its books of accounts. You need to identify. If at all there are fictitious customers, entity can pass fake sales to that fictitious customers, and revenue will be increased. Correct? So you are showing the sales which have actually not occurred. Next, so fictitious customers, whether any shipment done without consent and agreement from the customer, and whether unearned revenue has been shown as earned. So this mostly happens in case of construction companies. So in case of construction companies, you need to recognize revenue on percentage of completion basis. So as and when the project gets completed, you need to recognize the revenue. But if, let's say for example, entity has shown complete income at the time of starting of the project itself, which is completely wrong. Like that, unearned income should not be shown as earned. Next, whether substantial uncertainty exists about collectability. See, if there is a uncertainty exists about the collectability of amount, you should provide a relevant provision for that. Understanding. Next, whether the customer obligations are contingent on other actions. So all these things you need to see to ensure that sales have not been overstated, and review the sequence in which sales invoice have been entered. So whether there is a proper sequence for all the sales invoices, or any of the sale invoice is missing. If any of the sale invoice is missing, it means that it is not entered into the books of accounts, right? So you need to review sequence of sale invoice, and review journal entries for unusual transactions. So if at all there are any unusual transactions, you need to review the journal entries. Calculate ratio of sales and return to sales. Sorry, calculate ratio of sales returns to sales. See, this ratio should be less. If, let's say for example, sales return to sales ratio is 50%, that means every 100 sales that you make, 50 sales are returning. It means that there is a high probability that entity is showing fake sales. Correct? So to check that there are no fake sales, you should once go through the sales return to sales ratio also, and you need to check whatever the sales returns that have come with the sale invoice. Understanding? Yes. Next, disclosures with respect to revenue. So what disclosures you make? See, these disclosures you can bifurcate into two. In case of other than finance company, in case of finance company. Finance company means like banking company, NBFC, all these are finance companies whose major income will be interest income or income from dividends. This will be their major income. So first of all, what disclosures should be given in case of companies other than finance company? Sale of products, sale of services, grants or donation that have been received, other operating revenues and excise duty. And in case of finance companies, the major income will be interest income, other financial services. So this disclosure you will give with respect to income. Next, other income. So other income means the income that is not related to the entity's core business. So if the entity is selling some shoes, then its operational income will be through sale of shoes. Other income will be the income that it has generated from other than shoes, like it has invested its money in some bank, it has got interest, which is a other income. It has got some commission, other income. Understanding? So other income means any income not linked to entity's core business. Examples: interest income, dividends, gain or loss on sale of investments. Now this dividend income is there now. Dividend income has to be recognized as income by the company only if a right to receive has been established. Now tell me, when the right to receive dividend will be established? At the time of recommendation by board of directors, or at the time of declaration of dividend by the shareholders? I have told you this point. Liability on the company will arise only when the dividend is declared by the shareholders. So right to receive the dividend for the shareholder also arises only after a declaration. So entity has a right to receive payment of dividend, only then you have to recognize it as income. Economic benefits associated with the dividend flows to the entity. Amount of dividend can be measured reliably. So other income include interest on fixed deposit. How you will verify interest on fixed deposit? First of all, you will obtain all the list of FDs that the entity is having. Next, you will check arithmetical accuracy of interest calculation that has been made. You will also ask for a direct confirmation from the bank. Please provide a direct confirmation whether this FD is actually there or not, because in case of Satyam scam, this is what happened. Satyam Ramalingaraju, he has created fake fixed deposit. To avoid such a situation, auditor will directly ask the bank whether FDs are actually there, and you will also check in form 26AS. This form 26AS, you can get it from the income tax portal. So in the income tax portal, if at all any TDS has been deducted, that TDS will be reflected in form 26AS along with the relevant income. So you should also see form 26AS, form 26AS, to see whether TDS and the relevant income, that is interest on fixed deposit, has been reflected. And with respect to dividends, you have to recognize dividend only when right to receive is established. I already told this particular point to you. Next, gain or loss on sale of investments in mutual funds. So this is some of the other incomes. Next, disclosure of other incomes. So how you will classify the other incomes? First of all, interest income, dividend income, other non-operating income, and net gain or loss on sale of investment. So these are some of, this is how you will disclose the other income. Next, purchases. So with respect to purchases, auditor, he needs to obtain clear understanding about organization and its production centers. Just like in case of sales, auditor understood revenue centers. In case of purchases, auditor needs to understand production centers. So in how many areas the production is happening, okay, from which areas the goods are being produced, you need to understand all those production centers. And there should be proper controls over the purchases. Just like we have seen controls over the sales areas, there should also be proper controls over the purchases. And with respect to purchases, there will be certain documents which needs to be verified by the auditor, cross checked by the auditor. First one is PO, purchase order. Purchase order means whenever the company has to purchase any product, it will first of all raise a purchase order. Based on the purchase order, purchase will be made. Next, grn means goods receipt note. Once the purchase is made, goods will be received into the godown, right? At that point of time, grn will be generated. Next, of course, purchase invoice, which will be given by the vendor. See, first these two are the internally generated documents, this one is external. Next, inward gate entry register while entering into the godown. So these are the documents that the auditor needs to verify for sample purchases and perform substantive audit procedure. Substantive is detailed audit procedures. Next, with respect to completeness of purchases, see, same kind of procedures that we have performed in case of sales. So first of all, perform cutoff procedures and check that correct accounting treatment for goods in transit has been followed. See, with respect to goods in transit, you should recognize it as a purchase only if the risk and reward is transferred. So it depends on the agreement vendor on the company. So for goods that are in transit, if any damage happens, the damage will be borne by the vendor only. That means risk and reward not yet transferred. So you should not recognize it as purchase. If risk and reward is transferred, you should recognize it as purchase. Next, obtain written representation, perform analytical procedures. Analytical procedures means already I told you, you need to perform consumption analysis, stock composition analysis, ratios, quantitative reconciliation of closing stock. This analytical procedure we have discussed in SA 520 separate standard, right? Next, with respect to occurrence, so you have to see whether in the books of accounts entity has shown any fictitious vendors and made payment to those fictitious vendors. So you should see whether there are any fictitious vendors, and for every purchase there should be relevant entry in the inward register. You should cross verify. Next, whether the quality inspection of good is done or not, you need to see, because the payment that you pay depends on the quality of goods. There will be different qualities of good. For each quality, a type of price will be there. So for while making the payment, you should ensure that you are making the payment only for the correct quality. Next, whether goods receipt note was prepared and signed, the same documents, purchase invoice was approved, whether stock record has been updated by store personnel, and certain special considerations, the same points they'll get repeated. Purchase invoice should be of original copy, and book purchase invoice only after risk and reward is transferred, already I told you. Next, purchase invoice should be in the name of entity, because you are booking this as expense in the books of accounts of entity, so purchase invoice should be in the name of entity. And input tax component should be booked in input tax ledger. So this input tax is concept of GST. Next, related party purchase should be approved by board of directors or the audit committee. Basically, as per Companies Act 2013, all the related party transactions, they should be approved by audit committee. If audit committee is not there in the company, then board of directors will approve. Review whether purchase should be capitalized or expensed of, right? Only capital expenditure should be capitalized and other expenditure should be expensed off to the P&L. And review journal entries for unusual transactions, that is with respect to purchases. Next, employee benefit expenses. So this employee benefit expenses, this will be simple, clear understanding of organization, its hiring, appraisal and retirement process. So you need to understand the HR policies of the organization simply, and controls that are there around the employee benefit payments. See, this employee benefit payment includes salaries, gratuity, PF, ESI, the relevant TDS that you make, all these they come under understanding. So there should be proper controls around this employee payments, and random sample of transactions you need to select and you need to verify them and perform substantive analytical procedure. In SA 520, I told you how you will perform analytical procedures with respect to salaries, number of employees multiplied by average salary you will take, and you will calculate the amount, right? Next, with respect to employee benefit expenditure, you need to disclose salaries and wages, contribution to provident and other funds, expense on employees, stock option, ESOP, and staff welfare expenses. These disclosures has to be made. And some of the audit procedures with respect to employee benefit expenses. So you need to first of all see whether there is a possibility of fake employee IDs being uh, entered into the uh, system. So if fake employees are created, every month you will pay excess salary, fake salaries you are paying, right? So for that, meet employees in person. Auditor, he has to meet employees in person, not all the employees, just at least some random people you need to select from the list and meet them in person to ensure that fake employee IDs are not created. And you need to obtain list of all the employees and see monthly movement slip. Monthly movement slip means monthly movement split means how many employees are leaving the organization, how many new employees are joining the organization. Next, for sample of new hires, so newly hired employees will be there, some sample you need to select and check whether the salary to them is being paid as per the agreement or not, terms agreed or not. And the employees who have resigned recently, you need to take a sample of resigned employees and check the final payment calculation. So when the employees leave the organization, there will be a full and final settlement made to the employees. Further, a calculation will be done. If at all there are any unused leaves, if at all there is any gratuity, the final payment you will calculate and you will give to the employees. That calculation sheet you need to ask. And monthly salary registered for all the 12 months, compile monthly payroll responsibility. And for all employee benefits and obligations, verify accrual and provisions have been made or not. Generally, as on 31st March, you need to check for the provision, because salary of April month, salary of March month, it will be given in the April month, right? But for preparing financial statements, March month salary you need to book it in the March only, so you need to create a provision. Next, PF ESI, is it applicable to the entity? If it is applicable to the entity, you need to ask for challans, deposit challans, whether monthly they have been properly deposited or not. And understand entity's process of capturing employee attendance. So generally in lot of organizations there will be a separate software which will capture the attendance of employees. A thumb impression software will be there na? So you need to see what process the organization is following and perform analytical procedures to obtain audit evidence about overall reasonableness. Next, depreciation. So depreciation is the one that you provide for PPE. Amortization is the one that you will provide for intangible assets. We have already discussed this, right? So with respect to depreciation, amortization, auditor needs to understand the accounting policy that the entity is following, and whether that accounting policy is followed consistently or not, you need to see. And depreciation calculated after adjusting residual value. Of course, for each and every asset there will be residual value. Whatever the depreciation that you calculate, that should be calculated on the value after reducing the residual value, right? So cost minus residual value multiplied by depreciation percentage you will use, right? Next, each part of PB with significant value has to be separately depreciated. This you will call as component wise depreciation. Component wise depreciation. So let's say for example there is a asset, a big machinery whose value is some 3 crore rupees. The useful life of that machinery is some 15 years, but that machinery comprises certain parts. The useful life of those parts is only 5 years. So after 5 years that parts has to be again replaced, and the value of that part is some 30 lakhs or 40 lakhs. In such a situation, it is better to provide depreciation for that part, for that component separately, which you will call it as a component wise depreciation. Okay, yes, most appropriate depreciation method should be followed. See, the depreciation method that you select should reflect the pattern of economic benefit to the entity. In such a manner you should select the depreciation method. And some of the audit procedure: understand the entity's process, verify depreciation calculation for sample of assets, ensure intangible assets are properly amortized. All these are simple points. Depreciation on revalued amount should be accounted from revaluation reserve. So if at all you have revalued the asset, so asset value 1 crore rupees, you have revalued it to 1.5 crore, then in that 1.5 crore further you will depreciate na every year. That depreciation should be charged to the revaluation reserve, because 50 lakhs you have increased the value of asset now, so 50 lakhs will be added to revaluation reserve. That 50 lakhs in future you will depreciate now, So at the time of depreciation, you need to charge the depreciation from the revaluation reserve. Next, analytical procedures on reasonableness of depreciation, residual value have been properly verified, change in useful life. See, if at all there is a change in useful life, so actually at the time of purchase, the useful life of the asset is 10 years. Now, of these 10 years, for the first 3 years, you have provided the depreciation. In the fourth year, you came to know that this asset can be used for 5 more years. That means total life is 15 years, you came to know. That means 3 years completed, still 12 years is there, right? So, from this point only, you have to prospectively provide depreciation. You should not again retrospectively provide the depreciation. Understanding? Yes. So from the time when change in the useful life of asset has happened, from that point onwards, the remaining value you need to depreciate over the remaining useful life, the new useful life. Getting it? So compute depreciation prospectively, not retrospectively. Next, obtain fixed asset register, obtain list of components by asking with the management, ensure depreciation. If in case component wise depreciation has to be provided. Next, ensure depreciation is charged from date it is ready to use. This is important. So you have to charge depreciation not from the date on which you have put the asset to use, but you have to charge the depreciation from the date on which it is ready to use. Even though you are not using, if it is ready to use, you have to start charging the depreciation. And see, depreciation calculation as per Companies Act is different, as per Income Tax Act is different. So here auditor should also ask for depreciation computation as per Income Tax Act, and depreciation has been charged as per useful lives. Next, other expenses. So with respect to other expenses, you will generally vouch the other expenses considering following things. So you need to ensure that, see, other expenses include electricity, rent, salaries we have already seen, power and fuel, right? All these transportation, all these they come under other expenses. So you need to see that while vouching, these other expenses relate to current period only and qualified as revenue expenditure only. If it is not a revenue expenditure, you have to capitalize it, correct? And there should be supporting documents for that other expenditure. So for electricity expenditure, there should be electricity bill. For power and fuel, there should be fuel bill. Understand? So for the other expenditure, you have to vouch the other expenditure through the proper bill supporting document, and has been classified under the correct expense head. So you need to see that this other expenditure has been properly classified under the correct expenditure head, and whatever the expenditure that you are incurring, that should be authorized by proper officer in the organization. So you should see that all the other expenditure are authorized and was in relation to entity's business. Personal expenditure you should not bring and charge to the entity's profit and loss account. Only business expenditures you should charge to entity's profit and loss account. Next, rent expenditure, it will be very simple. Obtain month-wise expense schedule and compare that rent payment with the rental agreements. Both should match. Verify if expense has been recorded for all the 12 months. So the rental expenditure, of course, it will be there for all the 12 months or not. So you need to see whether for all the 12 months rental expenditure is there or not. And escalation clause, you need to see. Escalation clause means generally once in every year or once in every 2 years, we will increase the rate of rent by 5%. Like this, it will be written in the rental agreement. That is nothing but a escalation clause. Next, verify if agreement is in the name of entity. Of course, the agreement, rental agreement, it should be in the name of entity, right? Yes. Next, power and fuel also same points will have. Obtain month-wise expense schedule. See that it is there for all the 12 months. Summary of power units consumed. Analyze the monthly power units consumed by linking it to units of finished goods produced. Next, insurance expense. See, entity, it will be having lot of insurances. For factories, it will take the insurance. On employees, it will take the insurance. So you need to ask the entity to give list of all the insurance policies that the entity has taken. And in case of insurance expense, you need to properly bifurcate the premium paid, okay, between current year premium and prepaid premium, because generally insurance policy will be for 12 months. right? Here I will write. Insurance policy will be for 12 months, and you will not take the insurance policy exactly on 1st April. You will take the insurance policy somewhere in the middle of year, but you will prepare financial statements as on 31st March. Let's say, for example, you have taken insurance policy on in October. So if you have taken insurance policy in October, by paying 12 months premium initially only you will pay. That means October, November, December, January, February, March. For first 6 months, it will be counted in the current period. As on 31st March, there will be prepaid premium for this insurance policy, which you should show as a current asset, right? Prepaid premium. So correctly classified between prepaid and expense for the period. Next, legal and professional expenses. Obtain a month-wise and consultant-wise summary. In case of a monthly retainership agreement, ensure that this expenditure is recorded for all the 12 months. Monthly retainership means generally some companies they will retain the professionals with them only, so that whatever the issue comes to the entity, that will be handled by that professional only. Mostly entities will retain lawyers like this by paying a retainership fees. Understanding? For non-recurring expenses, select a sample and vouch those sample. Be cautious as same may highlight a dispute. That means, see, if at all there are any litigations, if at all there are any court cases, entity has to disclose them. Entity might not have disclosed them. Auditor asks the entity, are there any litigations, court cases against you? Entity says, no, we don't have any litigations, court cases. But if you see in the profit and loss statement, entity is making certain legal expenses, some crores of rupees or lakhs of rupees entity is incurring as legal expenditure. So if you are incurring legal expenditure, that means for advocate you are giving. If you are giving means there are certain cases against the entity which advocate is taking up. That's the reason you are giving. So by seeing the legal and professional expense account, you will get to know whether there are any cases pending against the entity, ongoing cases. Next, travel, repair and maintenance, printing, stationery, miscellaneous expenditure. Same. See, select a sample and watch them. Prepare summary of expenditure on a monthly basis. Perform analytical procedure. Analyze expense per unit of good or product produced. So for the unit of product that the company produces, how much amount of power is incurring, how much amount of transport is incurring, like this you will calculate. Next, details of cryptocurrency or virtual currency like Bitcoin, Ethereum, various cryptocurrencies are there. Now, entity might be purchasing and selling these cryptocurrencies, trading in cryptocurrencies. So, what is the profit or loss that the entity has made in these crypto transactions? Amount of currency held as at reporting date. So, at the reporting date, that means as on 31st March, entity might be having some investments in the cryptocurrencies, right? So, how much amount is there in the cryptocurrencies? You need to disclose. Next, deposits or advances from any person for purpose of trading or investing in the cryptocurrency. So have you taken any amount from any other person for the purpose of trading or depositing in the cryptocurrency? If yes, you need to disclose. Next, other expenditure. So what other expenditure you will disclose? Rent, insurance, power and fuel, repairs and maintenance, legal and professional, printing and stationery, traveling expenditure, miscellaneous expenditure. These are the other expenditures that you will disclose. Basically, in the notes to profit and loss statement, the last other expenses will be there. Na? In that other expenses notes, these other expenses they will come. Next, disclosure with respect to corporate social responsibility. Corporate social responsibility means, as per Companies Act, certain companies they have to spend at least 2% of their profit on corporate social responsibility activities on the society. They have to spend. This is mandatory requirement for certain companies, not for all the companies. Now, in case of this CSR expenditure is applicable to the company, you need to disclose the following things. Amount required to be spent by the company during the year. So during the year, how much amount has to be spent by the company and how much amount actually spent by the company, and shortfall at the end of the year. So how much has to be spent and how much is spent. Okay, how much is spent actually and how much is shortfall. You need to disclose this. Next, total of previous year's shortfall. So in the previous year, preceding previous year, did you have any shortfall in CSR expenditure? That also you need to disclose. What is the reason for shortfall? So why you are not able to spend 2%, complete 2% on the corporate social responsibility activities? Reasons you need to mention. And if at all you have taken up any CSR activities, nature of those CSR activities. CSR activities means nothing but those activities that will benefit the society around you, like planting trees, education. All these are CSR activities, providing the activities for free. And details of related party transactions. Have you provided or have you performed CSR activities to related parties? If yes, you need to disclose the same. So all these things you need to disclose with respect to corporate social responsibility expenditure. So by this we have completed revision of audit of different items of financial statements. I guess this revision was useful to you. If you feel that this revision is useful to you, you know what to do. You have to let me know that this revision was useful to you by commenting in the comment section. So what should you comment? The best audit revision. Got it? So if you like the revision class, let me know in the comment section by commenting as the best audit revision. So yes, I'll be winding up this class as of now. We'll meet in the next class. Until then, take care. Bye bye. See you.